Good morning, folks. Welcome to the 2023 Budget Review webinar. My name is Dave Beattie. I'm the Legislative Compliance Manager at HR Talk. Today I'm going to be talking you through just some brief budget highlights, if you can call them highlights. And then we're going to just also look at a couple of issues in the payroll space that are of importance, particularly those areas that have changed. Next week, I will be doing a webinar on COID. We are now coming into COID filing season, so I'll just go through effectively what COID is and how COID works. And then on the 29th, I'm going to be doing what we call our tax year end webinar, and that's going to have some of the issues that we've covered today, but generally issues that are relevant in the payroll, PAYE, UIF, workman's comp, basic conditions of employment act space. So you'll get more information on that a bit closer to the time. Okay, so let's get into the budgets. I'm not too sure how many of you were interested in the budget because it always seems to be bad news. But as usual, and I seem to say this every single year, we had a budget holding thumbs that there would be some sort of positivity. And I think to a certain extent, we got that. I don't think it was as bad as I was expecting. But you know, you have to feel for the Minister of Finance because, you know, our currency is under pressure. Yesterday, we took a pounding due to information coming out of the US. Dollar strength is in the market and our currency took a pounding. We've seen interest rates rising almost every couple of months. People are under pressure. People are not able to pay bonds. I work with people who talk about the stress of having, well, never mind the stress of buying their first home, now being burdened with increased bond repayments due to interest. The economy is struggling, and obviously the economy is struggling because of issues like load shedding. You know, you can't tie your hands behind your back and expect, you know, the economy to thrive. We've had pressure on government to continue COVID-19 grant funding. You know, COVID might, you know, the pandemic might be over, but people are struggling. People out there are unemployed. So COVID grant funding has been extended. We've got civil servants who have totally unrealistic wage demands. That's hanging over government's head. And to top it all, spiraling crime and our national sport corruption. So people are battling, and you know, an additional burden in terms of tax increase would have been very harsh on the public. So the Minister of Finance had a difficult job striking a balance between spending priorities and the limited resources we have. Bear in mind, we can't continue to borrow at the rate that we are, and we'll cover that issue shortly. South Africa faced a consolidated budget deficit of 4.2% of GDP for 2023. That was down from 4.6% in 2021-22, and it's expected to decline further in 2025-26. We can only hope. Unfortunately, we have not seen the structural improvements in our country, and the growth rate is predicted at 2.5%, with real GDP growth at 1.4% in the next 2 years. Now, that's just not high enough to actually turn our economy and create the business opportunities and the employment that we need. The IMF predicts global growth to slow from an estimated 3.4 to 2.9%. So we all in the same boat, effectively. The only difference, the challenges that we face is that our country has got more challenges than just the economy. Interestingly, the commitment to absorb 254 billion of the Eskom debt, okay, is hugely significant. Obviously, they want to take that debt off the balance sheet. They want Eskom to be able to spend more money on other things. So higher debt, interest repayments has seen the country's debt peak at 73.6% of GDP. Now, that is huge. So that means everything that we're generating will soon be used to pay debt. South Africa will spend a staggering 1.1 trillion on interest over the next 3 years. And the 1.1 trillion is effectively a cost that now reach greater levels than each of policing, basic education, and health. I'll say this is a worrying trend. I think that's an understatement, because that money could be used much better somewhere else. The Minister of Finance did mention the government was bringing debt down for the first time since 2015, as borrowing would be reduced for the next 3 years to the tune of 267.3 billion. Still spending more money than we have. Having collected 93.7 billion more than expected, Treasury will use 57% of this money towards reducing our borrowing requirements. This will see the budget deficit narrow to 3.2%, as I mentioned earlier. Good news is government is projecting that tax collections will be 182 billion rand more than expected at the start of the year. The majority of this was due to the commodities boom, and we'll look a bit later at the impact that mining has. Also, we will look at a bit later SARS actions to counter criminal and illicit activity and improve their performance. I saw this stat and I thought it would be interesting to include, and that is, it's interesting to note that a 1% increase in inflation and interest rates, together with a 1 rand depreciation of the rand against the dollar, results in a 94.9 billion rand increase in our gross loan debt and a 6.2 billion increase in debt servicing costs. So that shows you how fragile our position is and how challenging it's going to be if we do face those challenges. A 1% increase in inflation is not a lot. And as I said to you, with the rand plummeting against the dollar yesterday, a 1 rand depreciation is also not a lot. So we can see a turnaround there and more money spent on debt servicing costs. That means less money spent on South Africa and our own challenges. South Africa still has very high personal income tax rates. And I mentioned this last year that personal income tax falls disproportionately on a small percentage of the tax base. An interesting stat is that 2.3% of the population pay 30% of the tax collected from individuals. Now that is mind-blowing. That type of stat would explain why people would rather immigrate, or people would commit some sort of fraud to avoid overtaxation. Treasury is committed to increasing the tax base through greater economic growth. I'm not so sure about that. Employment, not sure about that. And tax collection, we are pretty sure about that because we've seen increased tax collection rather than increasing tax rates. And luckily this year we didn't see increasing tax rates as well. So a greater effort needs to be made to bring the existing formal sector into the tax net. Now, I think you would all agree, you know, if we went out there and we looked at spaza shops and we looked at the informal sector, you know, handymen, plumbers, people who are working under the radar, who are not paying tax. The only way we get any tax from those people is obviously through the VAT cycle. And government is loath to increase that again because of its impact on so many people, including the needy. Public sector is projected to spend 903 billion in the medium term, of which 448 billion will go to your state-owned enterprises, public entities, and private-public partnerships. Is this going to generate growth, or is this going to provide more funds to be looted? Now, the skeptic in me suggests that the money provided to Eskom, if that money was used wisely, I'm sure there would be a significant drop in load shedding. But is that money going to just be put into this pit for corruption? When they talk about, I don't know if you saw on the news, knee pads costing 350 Rand being sold for 80,000 Rand. It just shows the extent of the rot in these state-owned enterprises. Are we going to see governments take the hard step of privatizing some of these so that money doesn't have to be put into this never-ending pit? Looking forward to seeing that. Back to Eskom, as I mentioned, the 254 billion in debt to ease the pressure on its balance sheet. They talk about that going into investing in transmission and distribution infrastructure. A lot of that obviously would have been vandalized. And also Eskom needs to conduct serious maintenance. Is that going to be done at an arm's length cost? And are we going to see the fruits of their labor? Time will tell. Government has also announced 2 measures to encourage investments in renewable energy and increase energy generation. We were expecting this. I think it's a bit too little. But from 1st of March 2023, businesses will be able to reduce their taxable income by 125% of the cost in renewables, and there's no threshold to the size of the project. And then the poor individual from the 1st of March, they will be able to claim a rebate of 25% of the cost of any such move, up to a maximum of 15,000. I don't think that goes far enough, but it is a step in the right direction. The fuel levy and road accident levy has not increased this year, which is a good thing, because that would have put significant pressure on motorists and the transport sector. We've already seen, as I said to you, the oil price and the dollar skyrocket. So, we couldn't have more money coming out of fuel. Personal income tax brackets have been adjusted for inflation, roughly 5%. And you will notice the tax-free threshold went up from 91,250 to 95,750. So what that means is if you earn 95,750 or less, you are not going to pay tax. Good move. The retirement and lump sum tax table was adjusted. This is the first adjustment in quite a long time, and it was adjusted upwards by 10%, namely 50,000. This means that retirement or retrenchment, that your tax-free once-in-a-lifetime amount will increase from 500,000 to 550,000. What that means is if you're retrenched and your package is 550,000, you would not pay a cent of tax. If you were retrenched and your package was 300,000, you wouldn't pay tax. And then the other 250,000 would be used against any retirement amounts cashed in when you retired. The transfer duty exemption has also been adjusted by 10%. So now properties valued under 1.1 million avoid transfer duty payments. I think that's also a step in the right direction, so that your low to middle class are not trapped with another tax. Interesting. I've just done an article on this new 2-pot retirement system. The government intends to publish revised draft legislation on this topic. It's going to be implemented from 1 March 2024. And what it effectively does is it separates your retirement savings into a savings pot and then a retirement pot. Now, that savings pot will be a third of the money in that fund. And, you know, if you fall on hard times, you're retrenched, there's the option of accessing the savings pot. I am going to talk in more detail on this topic at the webinar on the 29th of March, because the system is a little bit more complicated than I've just mentioned now, but there are also lots of unexplained issues at the moment that are back with government, Treasury, and we're hoping that in the course of this year we'll have more information. I think it's a good move because it does allow some sort of flexibility to the taxpayer, the poor taxpayer, and it also, you know, it prevents people from getting into expensive debts. There was no mention of NHR in the budget, which was a good thing. I'm not sure if my comment there is right. You know, there's no space for such expensive folly. I think they're going to actually push ahead on this shortly. Okay. Okay, and then there will be an increase in excise duties on alcohol and tobacco. That's also at the 4.9%, which SARS deems to be inflation. And you can read there what your favorite tipple is going to go up by. It happens every year. Government has no sympathy for smokers and drinkers. Then 66 billion is allocated to social development. You know, we're in a country where that's very important. And then 36 billion to fund the extension of the COVID-19 social relief distress grants, which I mentioned earlier, and that will continue to be paid until the 31st of March 2024. The 30 billion in terms of social grants, in terms of old age and disability grants, they will increase to 2,080 Rand per month from the 1st of April, and a further 10 Rand from the 1st of October. And then child support grants increases to 510 Rand from the 1st of October, while foster care grants increases to 1,130. 695 million will be available this financial year for disaster response, and a further 1 billion next year. Quite a scary figure that 695 million is not a lot of money, and it looks like money has been taken out of this disaster relief fund and used elsewhere. So if we have natural disasters, I think we're going to have a problem. Okay, now I've done a couple of slides on SARS. I thought you might be interested in just seeing what's going on at SARS. Progress continues to be made in rebuilding SARS. SARS has begun to lay a firm foundation under our current commissioner to increase revenue estimation, okay, through data-driven insights, artificial intelligence, and technology. I've noticed less spend on boots on the ground and more spend on technology and the use of algorithms to identify audit risk. That doesn't mean you're not going to get a field audit from SARS, but what it does mean is your higher earners are going to be put through the ringer in terms of SARS data collection tools. SARS, in their own words, wants to be a smart, modern SARS with unquestionable integrity, trusted and admired. They were there once, and I sincerely hope that they go back there. As I mentioned, technology and tools are the buzzwords, okay? And they are being used to detect fraud. And technology and tools also improve service to taxpayers. You'll have noticed that there has been some changes to the back end of e-filing. SARS are taking a lot of these things in-house and working on them, so money is being spent in the right place. The new technology that we speak about has seen more than 3 million taxpayers being automatically assessed, your auto assessments, and up to 75% of taxpayers received their tax refunds within 72 hours. So the combination of human effort and technology is benefiting taxpayers. The high wealth individual and large business sections have been well staffed and staffed with the right technical skills. And the aim at SARS is to provide segmented and customized services to individuals and businesses. So you're going to have experts and professionals in various segments providing services. So this will be used to improve compliance and enhance revenue collection. SARS is focusing on areas of non-compliance, including local and foreign base erosion and profit shifting. These are generally the big money, the big ticket items, and I get the impression that the small man in the street is going to be pretty safe. SARS are looking at collecting the big money, and that is on looking at those areas. SARS is looking with close attention to other revenue authorities, and they're working with those other revenue authorities to identify offshore accounts and offshore dealings. High net worth individuals have obviously sent money abroad or have access to money abroad, and the declarations in South Africa are not being accurate as these people mask their true wealth. So SARS is really focusing strongly in this space. SARS also pushing the voluntary disclosure program, saying to people, we have given you the tools to regularize your tax affairs. So, if you do get caught being non-compliant, SARS are going to throw at you the fact that you were offered the VDP process. And if you've chosen not to use it, then all the penalties at SARS disposal will be thrown at you, including the admin penalties, which the legislation changed last year to ensure that admin penalties were imposed as soon as your first return was late and not more than one return was late. Corporate and personal income taxes it obviously contributes significantly to revenue collection. And another stat that I found interesting was that 30% of the corporate tax collections was from the mining sector alone. So we have the mining sector to thank for the increased revenue collections in the last year. In line with SARS revenue management system and additional revenues are a function of tax administration efficiencies as well as improved tax complier behavior. So SARS are doing their bits, and SARS are saying that they're starting to see improved tax compliance behavior, which is a good sign. SARS believes that most taxpayers are honest and will comply when provided with the right assistance to meet their legal obligations. I still believe that there's too many people who are non-compliant. I have seen quite a few taxpayers coming out of the woodwork and wanting to achieve compliance. So the SARS letters and penalties are definitely working. And I hope SARS continue to assume that most people are honest, because our dealings with them have shown the contrary. So maybe the new commissioner is making the right changes. So, after years of corruption, state capture, SARS is being repurposed to deal with issues that are going to collect money and make significant improvements. And there's this confidence that SARS will implement a successful compliance program that will continue to increase the yield in terms of collections. And we'll see that in the budget in future years as revenue collection increases above expectations. Since the 22 budget speech, the economic challenges facing the country have become a massive obstacle to economic growth, job creation, and the reduction of poverty and inequality. SARS revenue collection remains the mitigating factor that allows for a stable financial framework. And that is so true. We've seen SARS performing above expectations, and that money is going into good deeds. Okay, so what I've done on the right-hand side of that table, you'll see the new tables for 2023-24. You will notice how the bands have shifted. So the thresholds have changed. The rates, the tax rates in each band, remain the same. But we see adjustments for inflation to ensure that people are no worse off. The additional, sorry, I think I might have missed the slide then. The additional medical aid tax credits have also changed. Just want to go back a step. Okay, I'm not sure what happened to the slide, but you will notice that the rebates have changed as well. The rebates changed from 16,425 for primary rebates to 17,235, and then secondary rebate from 9,000 to 9,444, and then your tertiary rebates from 2,997 to 3,145. The tax threshold, as I mentioned, goes up from 91,250 to 95,750. In terms of your medical aid tax rebates, we see an increase in that as well, linked to inflation. So your first rebate goes from 347 to 364 Rand. And then the additional dependence rebate goes from 234 Rand to 246 Rand. And then you'll see there the additional medical aid tax credits calculations. Those have been in place for a number of years. And if you don't know what that is, when you submit your tax return, your medical aid premiums and your out-of-pocket expenses are factored into this calculation to determine whether you are due an additional tax, a medical aid tax credit. Some of my older clients who have got high medical spend get up to 15,000 Rand reduction in tax due to this history. You'll see that there's no changes in the local interest exemption. That remains at 23,800 for under 65-year-olds. And 34,500 for over 65. I'm surprised this hasn't changed because it's been like this for years. And with increasing interest rates, people are being put in a position that they're paying more tax on interest. Pension fund contributions, all your rates and limits stay exactly the same. The 27.5% tax deduction for pension contributions, the 350,000 stays the same. Travel allowances, we'll talk about the travel allowance table shortly, but your travel allowance reimbursement goes from 4.18 Rand per kilometre to 4.64 Rand per kilometre. There's another table that hasn't printed, is not pulling through for some reason. We have on this slide, we have the deemed expenditure travel table. And this table is the table that's used when you calculate your travel deduction. And it puts your vehicles into bands and has a fixed cost, fuel cost, and maintenance cost. And What happens here is the bands have shifted slightly and your rates have shifted slightly because of the increase in costs. Subsistence allowances. The incidental subsistence allowance goes up to 161 Rand per day, and your subsistence allowance for, if you're going to pay an employee to be away for a day, and they're going to have to incur their own meals and incidentals, that goes up to 522 Rand per day. And then I've left this bit in from last year. As of March 2021, the legislation changed to say that if you were actually away between like 6 and 6 during the day, you would qualify for the incidental allowance as well, whereas previously you had to be away overnight. Severance benefits and retirement lump sum benefits. I've left this slide in there. Remembering that, payments in terms of severance and retirements use a specific table, the table that I showed you with the 550,000. And it's important to note that you have to have attained the years 55 years old, or there has to be incapacity and sickness, or you're retrenched due to the various reasons in terms of the Labour Relations Act, in terms of retrenchment reasons. So I'm not sure why that slide's also not printing, but this slide shows the increase in the bottom rate, should you be retrenched or should you have lump sum benefits. The tax-free exemption used to be 500,000, now it's 550,000. Should you choose to withdraw from a retirement lump sum prior to retirement age, the table is usually penalizing. You only get an exemption of 27,500, and that's to encourage you to stay in employment and not retire early. SARS interest rates, I've just put this in just for your interest. You can see the most important one for payroll is the fringe benefits interest-free loans rate, and that has gone up steadily over the last year to 8.25%. What that means is if you are lending your employee money and you are not charging 8.25% interest, SARS will tax you on the interest figure that is lower than the 8.25%. So your payroll system will have the loan balancing, the loan repayment amounts, and we have an option to put in the percentage. So if you chose to only charge 5%, the employee would pay fringe benefit tax on the 8.25 less the 5%, whatever that interest figure was. That would be included into their taxable income on a monthly basis. As you can see, if you late payments to SARS, you get now 10.5% interest. But if SARS owe you money, they only pay you 6.5%. Company tax rates, financial years ending between 1 April 22 and 30 March 2023, you'll pay 28%. And then the concession that was mentioned a couple of years ago, if your year end is after 31 March 2023, you'll pay 27%. Apologies again about this slide, but this slide just deals with small business corporations. And when I send you out the slides, you'll be able to see the tables that are applicable to small business corporations. There's no change for 2024 in the turnover tax regime for small and micro businesses. This slide shows the transfer duty increasing to 1.1 million Rand. ETR, the ETR legislation stays exactly the same. So your calculations for ETR, the thresholds and limits, stays exactly the same for the next year. In terms of challenges in the ETR space, we always lodge inquiries through PEXA, Payroll Authors Group, to the various authorities in terms of administration around ETR. We haven't got all the answers yet, but we also have heard that there are going to be additional changes to the ETR regime, and we anticipate those being published within the next half year. Recent research has indicated that ETR has an ambiguous influence. The scheme remains a great idea. However, if government simplifies the administration of ETR, it could encourage more employers to participate. Now, I agree with that wholeheartedly. ETR is far too complicated. And with government introducing legislation that's going to penalize people for mistakes in the space, we've seen a lot of employers just refuse to even participate in the ETR regime because they're scared of SARS audits and penalties. I've left long service in again this year because this is an issue that is very poorly dealt with, and long service was relooked at in the last financial year, the 2023 year. And remember that long service is 15 years unbroken initial qualifying period, and then every 10 years after that. So that means you can qualify for long service exemption, the 5,000 Rand exemption, after 15 unbroken years, and then 25, 35, 45, and 55 years. If you miss the 15-year period and you pay the long service for the first time at 20, you would then only be able to pay long service awards at 30, 40, 50, 60 years. As I mentioned, as of 1 March, the 5,000 exemption includes cash payments. Gift vouchers have always been an inclusion, even when the legislation referred to an asset, because the gift voucher represents the right to acquire an asset of the employee's choice. Krugerrands also regarded as assets and would apply to such benefits. What hasn't changed is the 5,000 Rand threshold for some reason. So if you're going to work out the long service calculation, what are the issues you need to look at? You need to look at, has the 15 years unbroken service been met? You have to determine the value of the award. That would be particularly important if you were buying assets or you were giving the employee a company-owned asset where the value would actually have to be quantified. And then the value of the award can be reduced by the lower of its value and 5,000 Rand. Last year, they introduced the new IRP5 code for long service, code 3835. And then all awards would basically go into that code, and then SARS on assessment would reduce the taxable income in that code by the 5,000 Rand exemption. Should the long service award take the form of the acquisition of an asset at less than its actual value, or the right of use of an asset, then IRP5 codes 3801 and 3806 must not be used. Now, those are the codes that you would normally use if you did have the acquisition of an asset or the rights of use of an asset. But if that acquisition relates to long service, then you still have to use code 3835. And as I said, SARS has chosen not to increase the 5,000 Rand exemption. Moving on to the dreaded UIF compliance certificates. Many of you would have had challenges applying online to the new online system that that the Department of Labour introduced in 2021. When it worked, it was superb. You would put in the information and you would get your clearance immediately. However, we soon noticed some irregularities, and we started to see rejections where the employee start date and the first contribution did not match. We also had problems where previously non-compliant employees are attached to a current employer, causing the denial of a certificate. And every time we reapplied, new errors would be cropping up, such as irregularities going back to 1971 in some cases. Now, obviously, we don't have information going back that far, and we're unsure that why that's a problem, but huge challenges in the space. Now, companies just did not get feedback as to how these would be fixed. And thanks to the payroll author group and the various other statutory bodies, the various bodies approached the Department of Labour to convince them to sort of reduce the requirements in terms of getting such a compliance certificate. And we'll look at the letter that they published a bit later. And the good news is that the Department of Labour backed down, and the electronic certificate for compliance would not be issued until a future date. I've heard recently that there has been some very productive meetings with the Department of Labour, and that this certificate, this online system, might be running by the second or third quarter of 2023. This slide shows the actual letter from from the Department of Labour, in terms of the compliance certificate, and it can be used in a tender to show why you don't have a compliance certificates included in your bundle. In terms of the BCEA, every year the threshold changes, and this year is no exception. As of 1 March 2023, the earnings threshold goes from 224,080 Rand and 48 cents to 241,110.59 cents. Now, anyone earning above this threshold is not entitled to receive overtime or automatic protection in terms of things like ordinary hours, compressed work week, average hours of work, meal intervals, daily, weekly rest periods, Sunday pay, night work, public holidays, not ordinary worked. So obviously the protection is for people who earn under that threshold. We've also seen a change in the national minimum wage. Gazette 48094 of 21 February 2023 confirms the national minimum wage at 25.42 per hour. Now that rate applies to domestics and farm workers, but not public works program workers. Their rate is 13.97 per hour. The rates applicable to workers who are working through learnership agreements and the contract cleaning and wholesale retail industries also have different rates, and those are published in a separate schedule. In terms of the national minimum wage, the basic conditions of employment defines an employee to exclude independent contractors. The national minimum wage defines a worker in the same manner, but does not exclude independent contractors. The effect is that independent contractors, in terms of the common law, must be paid at least the national minimum wage. This does not apply to the ETI and UIF Acts, though. These acts see independent contractors as employees if their trade is seen to be independent. This slide, I've included the definition of worker in terms of the National Minimum Wage Act, and the definition of wage and remuneration is there for you to read. And then finally today, just a look at gift vouchers and other benefits. We all agree that we're having tough times, and we've seen changes to remuneration practices. Many employers are forgoing traditional bonuses, Christmas parties, etc., and giving employees meal vouchers. I get quite a few of these queries. In terms of vouchers or gifts, Should you provide that to your employee, that constitutes a taxable fringe benefit, and you would have to process it through the payroll. But don't confuse that with providing a meal during work hours or extended work hours to an employee. That is specifically excluded from the fringe benefits. And then the last point is, if there's no ties between receiving the gift and the employment, etc., a birthday or anniversary, then there's no tax implication. Now that point is debatable. That is the logic that I apply. I have seen some heartless SARS officials try and tax flowers on the birth of a child and things like that. But 99.9% of SARS officials will not tackle those issues. Folks, as I said, I will be sending out the slides for you to look and keep. And just a reminder, next week is COID webinar. It has been presented before, so if you have attended it, you don't have to attend it again. There are some changes in the values in terms of limitations, and particularly in payroll, and then in terms of assessment, what the basic limitations are in terms of payments. But I will cover all those issues. I will cover how to claim and how we can assist you. I just want to have a quick look at, I'm just having a look at the questions. I see that some of you had audio problems in the beginning. We will send out an audio recording if you want. We will also put this on our YouTube and on our website, so you will be able to have a look. I apologize for that. I'm not sure what the reason for that is. If you have any questions in this regard, please feel free to drop me an email at dave@hrtalk.co.za. I'm more than happy to help. And thank you for your time. Sorry about the technical issues, but I look forward to seeing you at future webinars. Thank you. Have a lovely day.